There is a quiet, almost invisible trap that swallows billions of dollars every single year. And the most frightening part is that the people walking right into it believe they are being smart. Think about the last time you watched the financial news or saw a stock chart climbing straight up into the clouds. Everyone around you is talking about it. Friends, colleagues, strangers online, they are all winning, they are buying in. And right at that exact moment, a heavy, suffocating wave of anxiety washes over you. It is the fear of missing out, the terrifying whisper that says, if you don't buy right now, you are going to be left behind forever, so you give in. You click buy, you invest your hard-earned money at the absolute peak, and almost immediately, the market turns. Why does this happen over and over again? Why do human beings, rational, intelligent people, consistently buy stocks at the worst possible time? To answer that, we have to look away from the charts and look deep inside the human mind. Decades ago, a quiet investor sitting in Omaha, Nebraska, noticed something profound about human nature. Warren Buffett realized that the stock market is not a pure mathematical machine. It is a giant mirror reflecting human emotion, our greed, our panic, our impatience, and our vulnerability to the crowd. While the rest of the world rushes in when the water is warmest, Buffett does the exact opposite. He waits, he watches, he stays completely still while everyone else panics. And the reason why most people buy at the wrong time isn't because they lack intelligence. It's because they are fighting a biological wiring that has kept human beings alive for thousands of years. Only in the modern financial world. That exact same survival instinct is designed to destroy your wealth. Let's step back and look at how we got here. Imagine walking into a crowded marketplace on a crisp autumn morning. Stalls are overflowing with rare fruits, gleaming metals, and fine fabrics. If you see 100 people stampeding toward a single vendor, shoving each other out of the way to grab the last remaining item, what is your immediate, unfiltered instinct? Your pulse quickens, your eyes widen, your brain screams, whatever they are buying must be valuable, I need it right now. For millions of years of human evolution, following the tribe meant survival. If everyone is running away, you run. If everyone is rushing toward a food source, you join them. Conformity was safety. Isolation meant death. Now, fast forward to the modern financial markets. The screen in front of you is flashing green. A stock is up 40% this week alone. Social media feeds are flooded with screenshots of overnight fortunes. Your ancient tribal brain takes the steering wheel. It doesn't see a complex balance sheet, a shifting macroeconomic landscape, or inflated valuations. It sees a stampede. And just like our ancestors running toward the crowded vendor, you feel an irresistible biological compulsion to join the crowd. This is where the trap snaps shut, because in nature, a crowded food source is good, but in finance, a crowded stock is almost always overpriced. Warren Buffett spent a lifetime studying this exact phenomenon. He famously observed that the stock market is a device for transferring money from the active to the patient. Yet, human beings are inherently wired for action. When we see prices rising, doing nothing feels painful. It feels like losing. Our brains are hardwired to equate motion with progress. If we aren't buying, selling, or checking our portfolios every 5 minutes, we feel like we are falling behind. Wall Street knows this better than anyone else. Modern financial media, trading apps, and algorithms are meticulously engineered to trigger that exact primal urgency. They don't sell analysis, they sell adrenaline. They flash bright colors, real-time ticker tapes, and breaking news alerts designed to keep your nervous system permanently locked in a state of high alert. When you are constantly stimulated by fear and excitement, your long-term rational thinking shuts down. The prefrontal cortex, the part of your brain responsible for calm, calculated analysis, takes a back seat, and the emotional, reactive limbic system takes total control. This is why ordinary investors buy at the peak of euphoria and sell at the bottom of despair. They aren't making financial decisions, they are having emotional reactions to manufactured urgency. Buffett understood that to succeed in investing, you have to do something deeply unnatural. You have to actively fight your own biology. When everyone else is hyperventilating with excitement, you have to cultivate absolute calm. When the crowd is stampeding toward the cliff, you have to stand completely still. Easier said than done, right? Because feeling the pressure is one thing. Resisting it when your entire social circle is getting rich is an entirely different battle. So, how do the master investors manage to disconnect themselves from the emotional contagion of the crowd? To find out, we have to look at what happens when the music stops playing, and the euphoria turns into sudden, icy silence. Have you ever noticed how quickly excitement turns into blind panic? One day, everyone is a genius investor. The next day, a single headline drops, a single interest rate ticks upward, and the entire atmosphere shifts in a heartbeat. This is where the second half of human financial psychology takes over: loss aversion. Behavioral economists have proven time and time again that the psychological pain of losing $1 is roughly twice as intense as the joy of making one. When the market begins to dip after a massive peak, the same people who bought at the worst possible time because of greed now experience a sickening drop in their stomachs. The losses start mounting on their screens. At first, they tell themselves it's just a temporary dip. They hold on, watching the numbers bleed. The anxiety becomes a heavy physical weight. It keeps them awake at night, staring at the ceiling, replaying their decisions. And then, right at the absolute bottom, when the pain becomes completely unbearable, the human mind reaches its breaking point. The investor whispers to themselves, "I just want to stop the bleeding. I can't take this anymore." And they sell everything, locking in their losses. They bought at the peak because of hope. They sold at the bottom out of sheer terror. Warren Buffett watched this cycle repeat itself across decades, generation after generation, through crashes, panics, booms, and recessions. He distilled this observation into one of the most famous and counterintuitive rules in the history of finance: be fearful when others are greedy, and greedy only when others are fearful. Notice the brilliance of that phrasing. He doesn't say be greedy when things are going well. He says be greedy when others are fearful, when the streets are filled with blood, when everyone else is running away in absolute terror. Why? Because that is when true value is created. When panic sets in, the market doesn't discriminate. Good companies and terrible companies are thrown out together like garbage. Prices drop far below their actual intrinsic worth simply because people want cash at any cost. This is the moment the patient investor waits for. While the crowd is paralyzed by fear, the disciplined buyer steps quietly into the empty marketplace and picks up extraordinary assets for pennies on the dollar. It sounds simple on paper, but executing it requires a level of emotional detachment that most human beings spend a lifetime trying to master. Think about what it actually feels like to buy a stock when every single news outlet is screaming that the economy is collapsing. Your hands will shake. Your inner voice will scream that you are making a massive mistake. Every instinct you possess will tell you to protect what you have and hide. That is the exact moment when the greatest fortunes are quietly built. Buffett didn't build his legendary empire by following the latest trends or chasing hot stocks. He built it by treating the stock market like a giant discount store. Imagine walking into your favorite retail store. If a winter coat you love goes on sale for 50% off, do you panic and run out of the store screaming that the clothes are losing their value? Of course not. You smile, grab the coat, and feel brilliant for getting a bargain. Yet, human psychology completely inverts this logic when it comes to stocks. If the price of a great business drops by 50% because of temporary market panic, people panic, assume the business is broken, and sell. They hate sales when it comes to equities. They only want to buy things when they are expensive, fashionable, and crowded. This single psychological flaw is the hidden engine behind why most people always buy at the worst time. So how do we break free from this loop? How do we stop our own minds from sabotaging our financial future? The answer lies in shifting our relationship with time and information. Most people treat investing like a spectator sport, a fast-paced game where you check the score every single day, reacting to every swing, every rumor, and every fluctuation. Buffett treats investing like owning a farm. If you own a productive farm, you don't walk out to the fields every 5 minutes to ask a neighbor what they would pay you for the dirt today. You don't panic if a bad storm rolls through on a Tuesday. You focus on the soil, the seeds, and the long-term harvest. You care about what the farm will produce over the next 10, 20, or 30 years. When you view stocks as fractional ownership in real, cash-generating businesses rather than flashing red and green numbers on a casino screen, everything changes. The daily noise loses its power over you. The panic of the crowd becomes background static instead of an urgent call to action. You begin to realize that market volatility is not a risk to be feared. It is simply the toll fee you pay for superior long-term returns. It is the price of admission. Those who refuse to pay that emotional toll, those who demand constant comfort and smooth, upward lines, inevitably end up paying the ultimate price. Buying high, selling low, and wondering why wealth always seems just out of reach. The secret to beating the worst time trap isn't predicting the future. It isn't finding a secret algorithm or timing the market down to the exact second. It is mastering yourself. It is recognizing when your ancient, tribal brain is hijacking your rational thoughts. It is pausing for 3 seconds when a hot tip crosses your screen, taking a deep breath and asking a simple question. Am I buying this because of deep, independent conviction, or am I just running because everyone else is running? The moment you can answer that honestly is the moment you step off the emotional roller coaster. And that is when real, lasting compounding finally begins.